Hello and welcome to the Private Capital Podcast. I'm Joe Reilly, head of Circulus Group, which is a forum for the family office world. We are hosting our first family office event in New York on September 19th. If you are a single family office and would like to attend, you can request an invite on our Substack, which is at circulus.substack.com. There's a link available under events, and I'll also include a link in the show notes for this podcast. We are happy to have Steve Tananbaum of GoldenTree joining us, and we will be covering private equity, fintech, and the global macro outlook with many talented speakers. I hope you can join us. Ken Kencel is the president and CEO of Churchill Asset Management, a $50 billion platform serving over 700 institutional clients. He shared valuable insights on the growing private credit market, the evolution of the industry, his first job at Drexel, working at Carlyle, and then going out on his own to start Churchill from scratch. We also discussed the nuances of the art of the covenant and finished with Ken's desert island discs. Ken started his career in M&A at Drexel Burnham Lambert, founded the high-yield finance business at Chase Securities, was head of leveraged finance at RBC, as well as head of leveraged finance at Indo-Suez Capital. He was president and CEO of Churchill Financial Group, which was sold to Carlyle, where he served as a managing director before starting Churchill Asset Management. Ken graduated magna cum laude from Georgetown and has a JD from Northwestern. Please enjoy my excellent conversation with Ken Kencel.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
No, I like to start with folks' background. Well, how come I'm not talking to attorney Kencel?
It's an interesting question. I did go to law school, obviously, and really never practiced for any significant period of time. But just to go background-wise, I grew up in Buffalo. I was actually an orphan growing up, so both my parents died when I was very young. And I was raised, at the end of the day, by my uncle, so my mother's brother. He raised me, worked in the steel plant in Buffalo. And his whole approach to life was, you can do better. You can, if you work hard and play by the rules and go to good schools and work on your studies, you can do better and you can have a better life. And so he was really the one that sent me to a really good high school in Buffalo, which I still sit on the board of. He's the one that ultimately encouraged me to go to college, which most of the kids I grew up with didn't, certainly in my neighborhood. But he was also the one that said you should getting an advanced degree to get a law degree, get a lot of education. So he was a big believer in that. And so I did that, but I also had a business degree. And so after I finished law school, it became pretty clear to me that I practiced for a short period of time, but I really wanted to be on the business side because I saw the business side as really making decisions, able to drive investment in transactions. And so pretty quickly, I shifted gears. My best friend in college was at this investment bank called Drexel Burnham, which was a place where a lot of very hardworking, entrepreneurial young people went to work. And so I interviewed there and I ended up going to Drexel at a very young age and changed my life and really, in many respects, the perspective of my career. It was an incredibly entrepreneurial place and one where I learned my trade, if you will. So.
I'm glad you brought that up because we know a lot about the Beverly Hills branch of Drexel, but I think the audience would love to hear more about the New York side and the M&A side under Leon Black. I always wonder, was that more of a case of the cart driving the horse? What were those days like?
It's funny, the movie Wall Street was filmed on our floor down on Broad Street. So I'll never forget, there was a whole weekend where they took over the floor and Michael Douglas and the whole crew was filming. I think we were working while they were filming, frankly, in another side of the floor. But it was a really interesting place. You had incredibly talented folks that were very early in their career. So you had obviously Leon, who headed up the group. It was called the M&A group, but it was really the LBO group, right? So we were basically the team that did financing. Everything was high yield. But if you did it in connection with a buyout or M&A, then it went to the M&A group. So we did worked on lots of the big financings of the 80s. I had lots of talented, incredibly talented group of folks in my world. You had Mark Rowan, Josh Harris, Rob Katz, who went on to run Vail, Jonathan Levine, who runs Bain Capital's credit platform, and a host of others that were all my generation. We were all kids together, and we all learned together, and we all fed off each other's energy and enthusiasm and hard work. And it was a great place to work, and we learned a lot. I certainly learned a lot. And obviously that ended in 1990. And then we all went off and did our thing. And a lot of us ended up going out and starting or participating in the high yield business, even post Drexel. So some of us went to banks, others went to private equity firms, but it was a very talented, capable group. And certainly in those relationships, many of them, maybe you think of folks that even were in corporate finance. Bennett Goodman is a partner of mine today. And eventually we have Ted Virtue, who was actually in the high yield commercial paper area. So we all started together, we grew up together, and we kept those relationships. I certainly have through the course of my career.
Any particular deals that stand out in your memory?
One in particular that got a lot of attention, which is funny in hindsight, but so Leon's kind of principal person that basically ran the department the day-to-day was a woman named Allison Mass. And Allison was super talented, and she basically ran the show. And all of us junior guys really reported to Allison. We all lived in kind of mortal fear of Allison because she was the assigning partner, and she'd be the one to come up to you on a Friday afternoon and say, "You're working all weekend on KKR's got a deal, and this is your turn." So the tar baby that went on for years while I was there was RJR Nabisco. So it became known as the deal that was ever, and actually nobody ever thought it was going to happen. Invariably, you'd have Allison or folks from looking for staffing for RJR because KKR would constantly revise and update their analysis, the breakup analysis, and all the financial analysis for RJR. So we all did our turn working on RJR at one point, and it was one of our colleagues who finally got this short straw or the long straw, depending on how you describe it, and ended up actually working on it. But we all touched it in one way or another because there were lots of financings and divestitures. But RJR was probably the biggest deal that got done while I was there. It was the biggest buyout trend at that point in all of our careers. But the funny thing is, it was not viewed as the premier deal to work on. It was viewed as the deal, oh my gosh, I would be telling your wife or your spouse, honey, I'm sorry, I'm going to be working all weekend long on RJR. So it was not certainly the glamorous deal. I think part of it was that the valuation needed to be right. The board needed to be in a position where they were going to sell. And of course, when they announced, I think it all started with Ross Johnson, the CEO, was going to do a buyout. And that's when all the private equity firms jumped in, and it became a much more viable deal because the board had committed to sell the company, and then everyone started looking at it. So it was always on everyone's radar screen, but it wasn't until there was an actionable dynamic that it became a deal that put the company in play.
Did you work with Richard Sandor at Indosuez?
I didn't work directly with Richard, but about 6 or 7 years after the Drexel experience, and we all went off on our own, I had spent a number of years and started the high yield business at what was then Chase Manhattan back in the early 90s. But ultimately, I ended up working with a bunch of my Drexel colleagues at Indosuez Capital, which was a prototype in many respects of today's modern private credit firm. So we were financing middle market private equity-backed companies. We were doing senior debt. We were doing junior debt. We were co-investing in the equity of those firms. And in many respects, the modern day business that I run today, Churchill Asset Management, looks a lot like Indosuez, but with a slightly different investor profile, but very much a very similar client base or private equity sponsor focus.
What was the opportunity that Indosuez saw back then?
What was interesting is that many of the big banks back then were really focused on the big buyouts, underwriting, distributing deals. But what was interesting is what Chase had been doing, old Chase, we call it classic Chase. And what Indosuez saw was the GE capital model of providing financing to mid-market buyouts and investing alongside their financing more of a merchant banking approach, if you will. And so what we saw at Indo-Suez was an opportunity to partner with a very large European bank that really had very little business or operations in the US and take advantage of this really attractive opportunity that we saw in investing and financing mid-market companies. And if you go all the way back to Drexel, that was the underlying premise that Drexel was really financing growing mid-market businesses, the kind of the growth companies of America. And so at Indo-Suez, there were 5 or 6 of my colleagues. We had all worked together at Drexel. So with the backing of a large foreign bank, we were able to build a business that became the prototype of the modern private credit business. In fact, if you look at some of the folks who worked there, that also turned out to be quite an interesting dynamic. So many of the folks that went on to work at Ares were there and helped build that business. And so they were partners of mine back then, and they obviously went off to great success. And so there were a lot of talented folks, and frankly, pound for pound, probably as much or more there as almost anywhere I've worked. So Drexel was one influence, and then going to Indo-Suez and seeing it play out in the context of a private credit investment platform really gave me the impetus to launch my own firm in 2006. And that model, if you will, the ability to finance mid-market buyouts, mid-market private companies, to back private equity firms, but to deliver an integrated financing solution. So you could do senior loans, we could do junior debt, we could do equity. We invested in the funds themselves, very similar to what we do today. And that model became very powerful because private equity firms saw it as very compelling. Gee, these guys can deliver whatever financing we need. Maybe senior debt, or maybe junior debt, or maybe equity. And so if you look at that business model, the fundamental front end of it is quite similar, although the investor side of it has changed quite dramatically in the last 20 years. Back then, it was bank capital, effectively, with a fairly limited amount of investor money. Today, our business is now all investor capital, or certainly TIA or third-party investors.
Did Indo-Suez have institutional investors? Was there institutional interest at the time, or was that a hard sell?
So back then, you really didn't have private credit funds. You certainly didn't have senior lending funds. You had mezzanine funds. You had middle market CLOs. You actually had broadly syndicated and middle market CLOs, sometimes in the same CLO. So in that sense, we had institutional investors in our CLOs, right? So they would put up a portion of the equity. They would obviously we would raise liabilities in the CLO structure. So the funding did have an institutional flavor to it, but it was more AAA, AA, a small amount of equity. The equity environment for CLOs was much more limited than it is today. And so I would say of the overall capital we had under management, about 60 to 70% was the bank, and 30 to 40% was institutional capital. So we did have institutional money, but it wasn't in private credit funds, at least not the kind of funds we do today. It was more in CLOs and kind of structured funds that still exist today, but that was really the only alternative. It wasn't until post-GFC that we saw the BDCs really take off and private credit funds in the more traditional sense of senior lending funds take off the way they have in the last decade. But back then it was more bank capital and CLOs. And of course, all the banks were still very active. So back then you had a whole host of active mid-market lending banks like Bank of Boston and Fleet and First Chicago and Chase and Chemical and Wachovia. We're all doing this middle market lending. And gradually, as a result of bank consolidation, a lot of them merged into 3 or 4 big banks as a result of increased capital requirements. And of course, post-GFC, you saw the business really wholly transform itself to more of an institutional-backed model, which I think has been a good thing overall.
So what made you decide to leave Carlyle, go out on your own? What challenges did you face in growing a firm like this from scratch?
So we launched Churchill in 2006, and the premise behind it, because this kind of connects it back to Carlyle, the premise was that if we built a best-in-class senior lending business, that the institutional appetite to invest in senior loans like the banks were doing, that this bank transition, this bank consolidation, this increased capital requirements and the impact of that would ultimately lead to institutions becoming much bigger investors in private credit. And that, in fact, happened exactly. And so if we built a very high quality senior lending business, that it would be a business that would be very attractive to traditional and alternative asset managers. And so that's exactly what happened. So by the time we got post GFC, the private credit business had begun to take off in terms of institutional interest in investing in senior loans. The banks had been moving away, and that accelerated. And so firms like Carlyle, who had gone public, and others like KKR and Blackstone and other firms were looking to get into private credit. And they were looking for teams that had a track record. And we had a very good track record and a history of providing financing and private credit in the middle market. And so Carlyle didn't have that at all. And we saw it as a great opportunity to be the private credit platform for Carlyle. And so we sold the firm to Carlyle right after the GFC, and as the private direct lending business was taking off. So we all went there in 2011 and saw that as a way to really accelerate our capital raising by affiliating with a firm that had a great history and a great track record of raising third-party capital. And that was really the impetus for the deal.
What is the breadth of Churchill's organization today?
Just to connect the dots. So in 2000, after about 3 years at Carlyle, it became clear to me that the private credit business was going through another phase of growth, and that the most compelling model would be one that was affiliated with an asset owner that brought significant balance sheet capital as an investor, that had a differentiated dynamic in terms of being able to source transactions, and that ultimately could assist in continuing to raise capital. In 2014 is when we first started talking to TIAA, and we launched officially in 2015. And so that really was the connection to the modern, today's version of Churchill Asset Management. So we have been an affiliate of Nuveen, which is the asset management arm of TIAA, for almost 10 years now. And today the business has grown pretty significantly. So in fact, it's amazing. We started with a $300 million commitment from TIAA. So it looks almost antique now in hindsight. Here's $300 million and don't lose any money. And if it doesn't work out, we gave it a try, right? Today, we manage $25 billion for TIAA. We manage across the US and European credit platforms between ourselves and our sister business at Arcmont, which is European private credit. We manage over $75 billion on behalf of over 700 institutional investors. We have about 3,000 investors, including family offices and individual wealth investors, obviously have publicly traded, publicly listed vehicles. So today, our business overall is now under the umbrella of Nuveen Private Capital. It has the Churchill business, which is the US business, and Arcmont, which is the European business. Our Churchill business manages about $50 billion of capital. That's split between $25 billion or so in senior lending, where we focus on providing traditional senior and unitranche loans to mid-market companies. And in the junior capital business, where we do mezzanine, second lien, junior debt, equity co-investments. That team also manages investments in over 300 US private equity funds, sits on the advisory board of 250 or so of those firms. And so that dynamic, that edge, if you will, those relationships and the investments in the private equity funds, not only does it help us identify the top performing funds, but it gives us ongoing connectivity to virtually every private equity firm in the United States. And it's that dynamic, which originally came through with TIAA, has proven to be a real differentiator in terms of sourcing and giving us an advantage when it comes to access to deal flow. So today we're $25 billion in senior lending, $25 billion of junior capital, including equity funds, junior debt, secondaries, venture capital, all of which now we manage. We do that on behalf of a global investor base. We have, I think, a dozen or so $1 billion plus relationships at Churchill where we manage capital for sovereign wealth funds, insurance companies. We publicly announced that we're a partner with Australian Super, a large superannuation fund based in Melbourne, where they manage retirement assets for Australian individual investors. So that the genesis really has been one of starting with TIA and managing capital for them in all of our strategies, but then significantly diversifying it to raise third-party capital in all of our strategies. So in senior lending, TIA is one of many investors that we manage capital for. Junior capital, same thing. Private equity, the same thing. So TIA annually allocates around $4 billion to our business. So each year they're allocating to our strategy. So we have TIA and we have the alignment of TIA, which investors really like because we're putting our own capital in every deal, every investment, we're directly aligned. But then we also have significant third-party capital with both institutional investors and individual investors. And that's quite a unique model. So we've diversified well beyond TIA. Right? And that's become, I think, a really important dynamic that investors to see.
How does a company change at various asset sizes? You folks made a great leap during COVID. And we used to have this conversation a lot in the RIA space because RIAs used to get trapped at 2 billion, 5 billion, and 10 billion.
Yeah.
And there always seemed to be this bottleneck, and we're always trying to figure out what that was. And I'm wondering if there's similar dynamics in your space as well.
No, that's a great question. It's a great question, Joe. And in fact, if you think about our market, what I would call the private credit market more broadly, there are really three areas now within the market that firms focus on, and it's become pretty segmented in terms of the dynamics. And that segmentation relates back to effectively how much capital you're raising, right? So I would say that there are, in our market today, if you look at the competitors or the players in private credit, there are a lot of firms that are playing in the smaller area, right? They've raised 500 million, maybe $1 billion, and they're landlocked, or they're certainly haven't grown beyond that amount of capital, maybe a few $1 billion. But in order to maintain diversification and to really do it and invest in a diversified and a selective way, they're really consigned, if you will, to the smallest deals. So it's a space where the lower middle market is one where you have lots of players. You have in my view, an increasingly competitive dynamic. And you certainly have firms that have been doing it in that space for a long time. But I think it's a space that is increasingly subject to more competition because as more and more firms love the idea of building out private credit, where you have to start, right? You're not going to start doing multi-billion-dollar deals. So the smaller end of the market, which is generally where we don't play, are companies with up to 10 million or so of cash flow. They could be sponsored or non-sponsored, and they're raising financing of up to, say, 50 million. And so that's what we call the lower middle market. And then at the large end, right, you've had some firms that have raised significant capital that can and are doing billion-dollar transactions today in private credit. And the trouble with that segment is that up there, you start to bump into the syndicated loan market, right? So suddenly, it's great that it's a larger company, but what we find is that pricing tends to get lower, tends to get tighter, spreads are tighter, leverage tends to be higher, and this phenomena that we call covenant light is really the norm. So at a size level, even though theoretically larger is better, bigger companies, et cetera, when you start to look at the economics and the terms in these larger deals, you start to question, okay, am I really delivering private credit, or am I delivering really a liquid credit substitute that may in fact look a lot like the liquid loan market with, of course, no liquidity? So the area that we've staked out is really the core middle market, right? So these are companies that are larger than those smaller middle market deals. These are good sized businesses, typically market leaders in areas like software, healthcare, business services, but they're not so large as to have graduated into that liquid loan market world where you're basically competing with the investment banks that are underwriting to distribute to CLOs and to mutual funds. So scale and building a business to scale, in my view, means having the scale to be able to underwrite and hold up to $400, $500, $600 million per deal to play in that core middle market. And in order to do that and yet stay highly diversified, you really need to have rough numbers overall. You need to have under management at least $10 billion or more in private credit. So you can be diversified, but you can speak to the larger amounts per deal that are being required to compete for the most attractive credits in the core middle market. So it's a balancing of the ability to step up and underwrite 500, 600, 700 million per deal with the need to stay highly diversified at the investor level, at the portfolio level, at the fund level. And so that crossover point tends to be around $10 billion or so under management. So you see some firms that get stuck at a few billion, and so they're consigned to the smaller end of the market. You've seen some other firms that have raised very significant capital that almost feel compelled and move into the really large cap world. But we've managed to stay very focused on this core middle market where we believe that the risk adjusted returns are most attractive, right? You're still getting very good pricing. Leverage is more reasonable. You get real covenants. You got a real ability to influence outcomes. And it's a big market. And that's basically the core area where we've played. And we can deliver, and this is a real advantage, we can deliver everything from senior debt all the way to equity in that core middle market. And we focused exclusively on firms that are owned or controlled by private equity firms. So we don't do non-sponsored deals. Everything we do is basically in and around this private equity ecosystem, if you will. We want to be trusted partners, provide financing, be able to do whatever they need, be able to underwrite at scale, and be valuable to them as a partner. And of course, with our private equity LP relationships, also be an LP, if you will, in their underlying fund, which gives us a huge advantage from a sourcing perspective.
How is sponsor activity impacting the volumes you're seeing right now in private credit?
First of all, I would say that deal activity has remained quite good. If you look at our business, for example, our overall level of activity on the senior lending side is up over 100% relative to 2023. So we just closed out our first half of the year, and we invested over $4 billion in middle market senior loan transactions, about half of which, interestingly enough, were new transactions, new deal, new M&A activity. The other half were really deals, whether they're refinancing or add-ons that came out of our portfolio. So I would say that deal flow has remained very solid. Now, it's not at the peak levels, but it's remained at levels that certainly for us have enabled us to be very active from an investment standpoint. And I would say that the quality of the companies that we're seeing in general is quite good. And I think that's because if you're a troubled company, if you're having challenges passing through price increases or otherwise dealing with the higher rate environment, you're probably not being sold. And so you're probably not in a new deal M&A environment. So I would say the quality's better. Deal flow remains good. Certainly, it's been great for us in the first half of the year. It's up dramatically. And I would say that the portfolios for the underlying private credit managers, certainly the higher performing ones, have also remained very solid. We're not seeing big cracks or big issues in our portfolio. So it's, in many respects, I think I call this the kind of the Goldilocks moment, if you will, where pricing is much, much better. So you can earn 11, 12% for a senior secured loan at 30 to 40% loan to value with reasonable leverage and covenants. And yet at the same time, if you've been a conservative lender, portfolios look pretty good and you're delivering good credit quality. And hopefully, if you're doing it right, I believe maintaining a high level of diversification and focusing on recession-resistant industries, you got a pretty good dynamic. And that's what's played out for us. So the net result of that is performance, portfolio performance, investment performance, deal activity, all beget increased fundraising, begets attractive deal flow and the ability to underwrite transactions of good size and good quality, which obviously enables us to deploy capital for investors and ultimately raise more capital. So it's been a good time for us. We're having a record year for the first half of the year in terms of investment activity. Our portfolio remains in excellent shape in terms of watch list and non-accruals and all those factors. And then we're also raising significant capital across our platform. I think we have 5 or 6 of our strategies that are in the market today raising capital, not just senior lending, but junior capital and equity in some of our other key strategies.
So this is kind of a broader question, but I'd be very interested to hear your thoughts on what you've learned about the art and science of covenants over the years.
You're probably the only person in the world who'll ask me that question. Actually, no, I've never had a position quite that way. The art and the science. I love that. So look, I think one of the things I would tell you, which I've heard over and over again, which I think is a bit of a misnomer, is that you'll sometimes hear credit managers say, in the lower middle market or in my area of doing credit, I get lots of covenants. I have lots and lots of covenants. I have 8 covenants. I have 12 covenants. The reality is 1 or 2 well-structured covenants get you to the same result, right? Which is basically requiring the company and the sponsor that owns the company to come back to the table when their equity is still in the money, meaning they still have skin in the game, and the problems that the company may be encountering are still fixable, or at least potentially fixable. And you can have a dialogue with the owner of the business on what they're doing to fix the issues, how much capital they're going to contribute to support it. How can we as a lender work constructively with the sponsor to provide flexibility to get to a solution? And all of that goes pretty well if you've got a well-structured covenant. You don't need 12 of them, but you need at least one of them, and you need a good one, right? So for example, if I've got a leverage test, a net leverage test, that covenant is going to get tripped, typically 20, 30% off a base case. So if I've got a company doing 50 million in EBITDA and that company's performance deteriorates to 40 million or 35 million of EBITDA, they're going to trip a covenant. But when they trip that covenant, there's going to be a tremendous amount of equity still in the company, and the private equity firm that owns it is going to still have skin in the game. So they're not going to walk away. And that's really the key. You want the covenant to be tripped. The art, if you will, of the covenant is you want it to get tripped in a situation where there is equity, there's still equity in the business. The private equity firm that owns it has a financial incentive to play ball, to work to get a solution. And many of them will do that anyway, but it certainly helps if they have real economics in the game. And if you have relationships with them and you have a history of living through some challenging situations, and we all do, nobody's perfect, and you have a covenant that's well structured, you can get multiple bites at the apple. You clip a covenant, you go through a fix, for whatever reason it doesn't work, you've done a reset. So now you almost certainly will get another bite at the apple. And it doesn't guarantee eventually you run out of bites at the apple. But you could often, in a well-structured situation, you might get 2 or 3 or 4 situations where you're involved in trying to fix a challenging credit. So I think it's not the number of covenants, it's how they're structured. I'll give you another dynamic that we're not big fans of: dividend deals. Why is that a problem? Well, and even if you have a covenant, because if the sponsor's taken all their money out and now you have a covenant breach, you may find yourself looking at each other and the sponsor is saying, look, I love you guys and we have a relationship with you and we appreciate all of that, but our equity's worthless and we've taken all our capital off the table and we're a fiduciary to our investors and you can't realistically expect us to put more money in. You can't put, quote, good money after bad. And so we're not big fans of dividends. We typically like to see 50 to 60% or more equity in our deals with a covenant that is structured so that they're going to clip that covenant before we get to a point where they're out of the money in their equity. And certainly if there's a dividend, particularly if it's a full dividend, then they're completely out of the money day one. So we don't like dividend deals. We like strong, high quality businesses with lots of equity. We don't need to have 50 covenants. Frankly, one good one will do the job of 50 bad ones. And so I sometimes hear this misnomer that we have lots of covenants. The art of covenants is not lots of covenants. The art of the covenant is having one really good one.
So I'm curious about Churchill itself as a business. One of the drawbacks of banks is that they have very high efficiency ratios, which is why private credit is so attractive as a business. Their ratios are much, much better. But how do you think about increasing your own internal margins as the firm grows?
Churchill as a business, and I may be one of the few folks that'll say this to you, but I think it's just fundamentally how we have operated. If you look at our business model, it's all about delivering for our investors, including being very flexible and reasonable on fees. So we earn our return by scale, by building scale, by being able to deliver for our private equity clients in scale, 500, 600, 800 million, certainly as large a transactions as we can do, but structured correctly. So it's all about delivering differentiated sourcing, alignment, the track record we have. We've been doing this now collectively as an investment team, 18 years. We have an average annual loss rate of 4 basis points a year. So we're definitely on a more conservative end. But when you think about how we approach the business, it's really all about delivering for our investors. And that includes being flexible on fees. So when I think about the economics, it's really all about building scale that enables us to grow our capital under management, to invest in our people, and attract, mentor, reward, and ultimately grow our culture and our people. And I pay less attention to the marginal fees that we earn per deal, because I recognize that it's much more important to have a $1 billion relationship that loves you and feels like you're working hard for them and delivering for them than optimizing your absolute fee on a $50 or $100 million LP relationship. So we've taken the long view, and that long view is we build scale, we provide highly differentiated investments. We do that in a way that both individual investors and institutions view as very reasonable. We built our business more on the institutional side. So we were really institutionally validated before we really ramped up our wealth business. Individual investors can look at our business and say, today it's 90% institutional. It's only been in the last several years that we've started to raise wealth products. Institutionally validated, the consultants, the large scale investors that frankly can invest with anyone now moving to the wealth side. So we're known as delivering very high quality investments at what would be, I would say, generally viewed as very reasonable fees. So the economics of our business, if you will, some people may call it, hey, we're long-term greedy versus short-term, but we're looking at it as we're building a business for the next 20 to 30 years, and trying to focus on maximizing your short-term fees, I think, is not the best way to get there. It's interesting also that our business model, you raised a very interesting question for me. If you look at our business model, the good news is that we've built significant scale. The counter dynamic is that because we manage so many different types of funds for investors, today we manage over 50 different investment vehicles for investors. So on the senior lending side, we have 35 or so different vehicles that we manage capital in. And on the private equity side or the junior capital side, probably another 15 or so. Now, why is that? Certain institutional investors want to invest in an SMA, or they may want to invest in a commingled fund, or they may want a levered fund, or an unlevered fund. They want to invest with seasoning facilities and have tax seasoning in their structure, or do they want to invest in a treaty structure from a tax perspective? Other investors may be more comfortable investing through middle market CLOs, where they do the triple B or the single A or the double A. It's important, in my view, to have different types of wrappers that are all effectively doing the same loan. So when we fund a loan, we might have 30, 35 separate funds that fund that loan with great diversification across all those funds. But when you roll it all up, we're delivering 500 million, 700 million, 600 million. That makes us relevant to our private equity clients. And interestingly enough, that rolling it up, if you will, is also very important to TIAA, because that TIAA on its own wouldn't be able to do 5, 6, 7, 800 million every single deal. So it gives all of our investors, including TIAA, access to scale. But the counter side of that, which is getting to your point about the business model, is that it requires a tremendous amount of investment in operations and finance. As you can imagine, when you're managing and reporting on 50 or so vehicles, I would say that the economies of scale in our business are less so on the operational finance side, because you want to keep adding talent and capabilities to support your infrastructure. There's a little bit more and a little bit better economics as you do larger deals. You don't have to exponentially grow your investment team at the same pace, because you're still being selective. You're doing maybe the same number or a similar number of deals, but you're doing more dollars per deal as your envelope gets bigger. So there's less pressure on adding investment people, but there's a lot of pressure on adding infrastructure and support for the care and feeding of hundreds, if not thousands, of investors that we have today.
Do you feel like technology's made a dent in that at all?
Oh gosh, yes. Oh gosh, yes. When I think about even our business 10 years ago when we got started versus today, there are certain functions that are being done on an incredibly efficient and effective way by various service providers that have gotten really good at doing very well-defined tasks. So I think technology, both the internal systems we use as well as where we use third parties, have all improved by leaps and bounds in terms of the fundamental underpinning. I think today we have, I'm going to say, a dozen or so third-party providers that we use in different areas of our business. And part of the challenge, of course, is connecting them all, right? Making sure that they're all talking to each other and that we're delivering. You may be a best-in-class system that does one very defined thing extremely well. Making sure that system talks to the broader organization or the other systems that we utilize is very important. The other, obviously, dynamic in the last few years is AI. And how do you use AI to make better investment decisions? We're obviously early days there. I don't think AI is ever going to replace fundamental judgment. I think that there's an element that will always go to the investment judgment of the professionals, but it can absolutely make us better decision makers from an investment standpoint. And we are particularly interested in that and ultimately invested in that. Here at Churchill, if you think about it, because we're such a large scale investor in private equity funds, we have a team that manages 300 investments in leading middle market private equity funds. That team sits on the advisory board of 250 firms. We get all their data, right? So let's say that every fund has 10 investments. So that's 3,000 companies where we have data on performance, track record, industry data in and around segments and strategies. So we are very busy investing in the infrastructure to take that data that we have on the private equity side and in the funds that we invest in. And obviously in the portfolio that we manage, today we have about 600 companies in our investment portfolio across the platform in the US. And getting all that data and making sure we've got it in a format that can inform better investment decisions. So it's a constant hunt for the best technology and, of course, ways to utilize AI to make better investment decisions. But technology has changed dramatically. I could think of the old days, Joe, when we were all using spreadsheets, right? It's come a long way, and you got to invest in that. We're in the midst of a major investment spend in technology to do exactly the kind of things I was just describing. So it's really important.
What did you think of today's Preqin deal?
I thought it was a very interesting deal. If you think about BlackRock and their investments and obviously focus on alternatives, it is obviously an investment in information in the alt space and getting closer to that data, which will enable them to, I'm sure in their view, deliver that knowledge and that information to ultimately the benefit of that to their clients. It makes a tremendous amount of sense to me. In some respects, I'm not surprised at all that they would invest in that way. Look, anytime BlackRock does anything, you got to pay attention, just given their size and scale. So I think it'll turn out to be a very good investment to them. I think technology, data, access to better data, better information, it's a huge focus on our part, and I think one that will deliver dividends to our investors for sure.
What are your thoughts on the future of the private wealth channel?
I am a big believer in the future of the private wealth channel and what that will do to our business and ultimately importance of private wealth in our investment business today and increasingly as we go forward. If you look at the last 10 years, Joe, of our business, one could argue that it's been the institutionalization of private credit. It's been big institutions waking up to figuring out, analyzing, and ultimately making the determination that allocating to private credit, and in particular, senior secured loans of various types, made a tremendous amount of sense, particularly given their floating rate, senior secured, excellent loan to value, and in the case of our lending, sponsor support. For the last 10 years, I've seen this evolution. I've had a front row seat, really, to watching institutions that I met with 10 or 15 years ago that had no allocations to private credit go to very significant allocations to direct lending into private credit in much the same way that they had already done that with private equity. So certainly the last decade has been one of institutional adoption of private credit. We're already early. We're obviously early days in that already. But I think the next decade is absolutely going to be the decade of the democratization of private credit, where the individual investors, not just ultra high net worth or high net worth, but also individual credit investors and otherwise, will look to private credit, particularly the kind of private credit we do, more conservative, floating rate, senior secured, market leading, non-recessionary, all the dynamics that an investor would look at and say, hey, this is attractive risk-adjusted return. If I can earn 10, 11, 12% in my retirement portfolio, that's a very good return with a high level of diversification. So I think you're going to see continued adoption on the part of wealth and individual investors. Obviously, you've seen tremendous growth in independent investment advisors, RIAs. We finance some of them, actually, interestingly enough. Private equity is a big player in the RIA space, and we've looked at them as partners in financing clients, as companies, but we also have them as investors. And many of the largest RIAs in the United States are clients of ours. And what I hear from them over and over again is, give me a conservative, stable, sleep at night, diversified, quality, risk-adjusted return. I don't need you to chase the last 50 or 100 basis points. They've figured out that the risk there is more significant. What they're looking for is a very sleep at night portfolio that can deliver them good risk-adjusted returns, investing in quality businesses. So I think we're going to continue to see demand for our products, and frankly, more broadly, for alternatives in the individual private wealth space. And if you look at the current allocations, even with the largest private credit, the largest private banks and largest RIAs, it's still hovering at less than 5% overall. I think what we will begin to see is that number go from 5%, 10, 15, and probably settle in somewhere around 20% over the next decade. As individuals are recognizing, individual investors are recognizing that it's not just about liquidity, it's about the underlying quality of the investment. So I think the 60-40 model will give way to the 60-20-20 model, meaning I want growth and I want to make sure I've got a portfolio focused on growth and equities, but I also want a broader exposure to alternatives, and whether that's private credit or infrastructure or real estate or private equity. I think that we're in the early days now of what will be a broader transition to individual investors, recognizing they're giving up a bit of liquidity to be in a private alternative space, but what they're getting is a very attractive risk-adjusted return, and much in the same way that large-scale institutional investors, particularly longer-term firms that have a longer-term focus, like endowments, and frankly, TIA is a great example. They have a very long-term focus. They have a very significant portion of their portfolio in alternatives. So I think this whole dynamic in and around wealth is still long-term. But I think in order to be effective there are some very real requirements. Well, one is you need to have certainly a respected and recognized brand in the space, right? You need to be a large-scale player that individual investors can look to and say, this isn't a fly-by-night organization. This is an organization, an investor that's been battle-tested by the institution. So being institutionally validated, I think, is a prerequisite to being a significant player in the wealth channel. And then I would say You need to invest in education. You need to invest in ongoing conferences and dialogue with individual investors. You need to invest in infrastructure to be able to communicate that story. And we're doing all the above. We think that the opportunity in wealth is huge. Obviously, we work through our Nuveen colleagues who have a significant presence in the wealth channel, both at the RIA level and in the large-scale brokerage platforms. And I certainly expect over the next decade that an increasing percentage of our assets will be through the wealth channel. If today the number is 5 to 10%, I would not be surprised if over the next 5 to 10 years, that number became 30 or 40% or maybe even more.
All right, Ken, most important question of the day. You're stuck on a desert island. What 3 albums do you have?
Wouldn't even talk about the fact that I play in a rock and roll band. You didn't even get to that one, which I have, but by the way, I've been doing it for like 20 years, right? So I would say 3 albums. Let's see. Let's go Allman Brothers, Eat a Peach, Hall & Oates, Abandoned Luncheonette.
Oh, interesting choice.
And let's see. Third one, probably Rolling Stones, Some Girls. I'd say those are 3. Now, of course, we do songs from all those albums, right? You know,
What do you guys play off Some Girls?
Miss You.
Awesome.
Yeah, we do Miss You. And I actually sing it, do my best Mick Jagger imitation. But although I have to say, he's pretty amazing. He's 81 years old. He's bouncing around on stage.
It's unbelievable. Yeah.
Yeah. But it's a testament to a long history of working hard at his craft. And people don't see that, but I think that's a big part of it. So.
Ken Kencel, thank you so much for joining us and sharing your great insights with us today.
It's great to be with you. Really enjoyed it as well.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.